When you look at agricultural SMEs across the continent and you ask them, what is it that you struggle with? What are your challenges? The number one issue over and over is we can't access the financing that we need. This cuts across countries, it cuts across value chains, different kinds of businesses, whether they're processors or traders or selling inputs, like they all struggle with this problem. And so this is the one common theme. And it's been this theme for years and years. It really hasn't changed in terms of, what is it that keeps you from becoming a stronger, bigger business? So we focus primarily on financing that is commercial or quasi-commercial. So we didn't spend a lot of time looking at donations or grants. They have a role to play, but in terms of long-term scalability and sustainability, it needs to come more from private sector sources, more commercial sources. And so there is venture capital or private equity, as you say. There are what we call global social lenders, lenders that focus on usually export-oriented value chains. They might serve co-ops, and they're going in with a social impact lens. And then, of course, it's not perhaps the most exciting part of the sector, but there are commercial banks, there are microfinance institutions. And those are the ones that we think are really the place where we have to invest because they've got the biggest role to play in unlocking financing for agricultural SMEs. When you actually look at whether investing or lending to agricultural SMEs, it's a tough space to work. If you're an investor, the returns are not very high. It takes a lot of effort and time to even put capital to work. If you are a lender, again, it takes a lot of time to conduct due diligence on a potential borrower, to originate the loan, to manage that loan. And then the risks are high. The risks have always been high because there's just a lot of uncertainty when it comes to the agricultural sector, particularly on the continent where a lot of our agricultural produce is rain-fed. And so there's a lot of unknowns there. Now you layer on top of that climate change, and so the potential risks in a systemic way have gotten greater, not less. And so when you look at the agricultural sector, when you look at agricultural SMEs, you're looking at a space where the risks are higher and the returns are generally lower than if you were to put that money to work somewhere else. And I think that's important to understand because a lot of the rhetoric around financing for agricultural SMEs almost accuses the actors in this space of not doing their job. They are doing their job because they're supposed to, for their shareholders, they're supposed to put money to work where they can get the highest returns for the lowest risk. Unfortunately, that often means parking it in, say, government bonds and not putting it to work in the private sector. And so if that's what their incentives are, if that's the rational thing for them to do, then we need to find tools and levers to nudge them to make it a little bit easier to lend into a sector that's critical for the growth of our food systems, but requires a little bit of help. And that's where this idea of de-risking can come in, and this concept of blended finance. I think there's three things for those in the sector to think about, and this applies to development financial institutions, philanthropic capital, governments. The first is thinking about co-design. A lot of ideas are put out there, perhaps using blended finance, where it sounds good on paper, but there's very little uptake. And that's because it hasn't been designed with the users in mind. So if you're designing something that's going to be used by a bank or microfinance institution, you need to work with them and understand what is it that they're looking for and why is it that the previous program you put out there, no one really adopted it, right? And so making sure that this makes sense to them. That's number one. Number two is coordination. A lot of times there's a lot of people floating in and around this space. I may not know what you're doing, you don't know what I'm doing. Maybe we're kind of doing the same thing, and then it becomes duplicative, and one of us, or maybe both of us, may be wasting a bit of effort, wasting a bit of development funding that could be put to better work. But we actually just need to talk to each other. And then the third one is, and final one that I'll mention, is making sure we have a transparent learning agenda in place. There's a lot of programs out there, and we don't do a good enough job of establishing a baseline and then revisiting regularly to see what's happening, what have we learned, and then being open about here's what was effective, here's what was less effective, here's how we actually changed the way something was happening versus this actually didn't have much impact and we always saw was business as usual. And I think having the mindset where we're willing to capture that data, do the analysis, and then actually put it out for the rest of the world to benefit from, and so that we're not repeating the same mistakes, I think that's critical.